Well, for decades, we've operated on a fundamental law in finance. Growth requires capital. To expand a business, you inherently have to retain earnings, reinvest them, and sacrifice immediate cash flow to secure future gains. It's a strict mechanical trade-off. But what if that core assumption is actually flawed? What if we're entering an era where the conceptual leap isn't just that growth costs nothing, but that growth actively generates a surplus? Today, we're exploring a paradigm shift. We're looking at a scenario where the cost of business expansion, what we'll call the cost of B, doesn't just drop to zero, it actually goes negative.
We're anchoring our analysis today in a compelling new article from the Averaging Up collection. It's appropriately titled Growth That Pays You. Now, this framework sets a highly intellectually rigorous standard for how we dissect and value the true cost of growth. We are going to move step by step through this thesis together, carefully examining the internal physics of modern business structures that completely defy traditional valuation methods.
So here's our progression for today. First, we'll look at the price of growth. Second, the arithmetic and physics. And third, why DCF models fail.
Section 1. The price of growth.
Every single generation of investors has eventually been forced to answer one foundational question. What should I pay for growth? For the better part of a century, the broader market has assumed that growth inherently consumes capital. Therefore, the question of what to pay has always yielded a positive answer, whether that cost is zero, a little, or a lot.
Historically, we see two absolute extremes on this issue. On one hand, Benjamin Graham argued that the price you pay for growth should be exactly zero. To Graham, growth is inherently uncertain, it requires capital, it requires human execution, and frankly, it can easily fail. So he demanded a margin of safety strictly on the tangible assets. But on the other extreme, you have Philip Fisher. He argued that growth is absolutely worth paying for and paying generously. His belief was that if a business can retain $1 and compound it at 20%, you should reach for the infinite hold. Yet even Fisher had to acknowledge that the growth of his era, looking at companies like Motorola or Texas Instruments, was undeniably expensive and required immense capital.
A bit later, Peter Lynch and Warren Buffett synthesized both of these distinct views into what we now know as GARP, growth at a reasonable price. They recognized that you shouldn't ignore growth, but you also certainly shouldn't overpay for it. The underlying logic here assumes that growth always carries a cost, and your job as an investor is to ensure the price you pay for that growth is reasonable relative to the expansion you're receiving.
But the Averaging Up collection recently introduced a fourth answer to this age-old question: growth at no price. This is what we call the Freesurfer framework. In this scenario, a business grows because an external, structural wave pushes it forward. Think of a company like MSCI. They don't pay for the global shift towards passive investing, they simply collect the toll as that massive wave arrives. The cost of expansion is effectively reduced to zero.
Section 2. The arithmetic and physics. Now the article introduces a radical fifth answer. The cost of growth isn't zero, it is negative. Really think about the magnitude of that statement for a moment. The business doesn't merely give you growth for free, it actively pays you to receive it. Let's look at the specific mathematical proof using Visa's projected spring 2026 arithmetic. You have a business generating roughly $13 in free cash flow growth. The cost to generate that growth is precisely zero because the digitalization of global payments is an external wave, one funded entirely by governments, banks, and consumers. The wave arrives uninvited and unpaid for by Visa itself, but simultaneously, Visa returns roughly $4 to its shareholders via buybacks and dividends. So, the absolutely crucial point is this: the net cost of the growth is negative $4. Because the growth consumes no internal capital, the entire free cash flow is a surplus, and a portion of that surplus is handed directly to you. You are, quite literally, getting paid to receive a gift.
Let's reiterate the mechanics here, because this brilliantly illustrates the core concept. For every block of shares you own, you receive that $4 in cash return. The internal cost of the $13 in growth was zero. That $4 is your direct payment for holding an asset whose 12 to 15% growth costs absolutely nothing. You are paid $4 to receive $13.
Now, we must draw a sharp line between this framework and traditional GARP. GARP operates purely on the market axis. Is the stock price reasonable? It's a mechanical conversation between the investor and the stock market itself. The negative cost framework, however, operates entirely on the physics axis. What is the internal, structural cost of the growth within the business?
You see, you can have GARP with a highly positive cost of capital.
You might buy a business at a very fair price, but that business still has to spend billions in acquisitions just to grow. A Freesurfer, on the other hand, has a negative cost regardless of its current market price. Even if the market charges a premium price, say a price-to-earnings ratio of 35, the internal physics of the business do not change. The growth remains free, and the surplus is still returned to you.
This matrix completes our spectrum of business architectures. On the far left, you have businesses where growth consumes massive amounts of capital. That's the traditional A alone model. Next is the A plus B model, where capital is still strictly required to expand. Then we move into the modern era with the Freesurfer version 1, where that external wave is free and the internal cost of growth drops to zero. Finally, you reach version 2, the climax of the framework, a negative cost where growth is entirely free and the unneeded capital overflows by sheer force, returning cash directly to the owner precisely during the compounding process.
To deeply understand why this happens, we need to look at the 15-15 loop. In the traditional mechanical world, a business earns a 15% return on equity, retains it, and reinvests it to grow. This closed loop strictly requires retained earnings as fuel, and it forces a binary choice upon the investor. You can either have growth or you can have cash returned to you. You simply cannot have both because the fuel can only be used for one purpose. In stark contrast to that mechanical loop, notice the blue downward arrow in this model. The Freesurfer wave provides the growth externally, so the loop runs entirely without fuel. Because the business doesn't need to burn its retained earnings to grow, those earnings become a massive surplus. And that surplus becomes your payment. You receive the growth the fuel would have historically produced, and you receive the fuel itself.
Section 3. Why DCF models fail. The article defines a fascinating phenomenon called the compression amplifier. Usually multiple compression, like a dropping PE ratio, is seen as a distinct negative. But for a Freesurfer, PE compression actively benefits the investor. As the stock price drops, the buyback yield mechanically increases. You're receiving the exact same free growth, but the payment you receive to hold it becomes larger. The negative cost becomes even more negative.
And this explains exactly why the standard discounted cash flow model cannot accurately price these modern businesses. A DCF model fundamentally assumes that growth is funded by reinvestment, and crucially, that this reinvestment reduces the free cash flow available to shareholders. It structurally forces a trade-off right there in the spreadsheet.
The spreadsheet fails because it treats independent variables as dependent. In a Freesurfer, growth is exogenous, reinvestment is zero, cash return is maximal. The model simply cannot reconcile these three numbers because it assumes the first determines the second and constrains the third. This structural flaw means your standard spreadsheet models might actually be blinding you to the most powerful compounding machines in the market today.
So we can summarize this entire journey across 5 distinct generations of valuation. We've charted a gradient starting from Benjamin Graham's profound suspicion of growth at $0, moving to Fisher's infinite horizon, to Buffett's reasonable price, to the Freesurfer's zero cost, and finally arriving at this new reality, a negative cost where growth actually pays you.
This complete evolutionary gradient represents a fundamental shift in capital allocation. We have moved definitively from Graham's strict margin of safety, relying only on tangible assets, to a mathematical climax where the internal physics of the business generate a permanent, standalone surplus.
The final conclusion of this framework is quite profound. You are quite literally paid to receive growth. The ultimate question you have to ask yourself is, are you still paying full price for growth in your portfolio, or are you ready to start getting paid for it? This content is educational and reflects a personal analytical framework. It does not constitute investment advice. Visit averagingup.com to explore the full collection.